This is Peter, a dedicated community health worker in his mid-20s who saved up $5,000 since starting his new job. See, Peter has always admired Warren Buffett, the legendary investor known for his wisdom in building true wealth. Inspired by Buffett's philosophy, Peter dreams of generating a steady stream of passive income through dividend investing. But he doesn't know where to start, which is why we made this video. The thing is, Peter has faced several financial troubles recently. Repaying his car loan has become a nightmare. And on top of that, he is struggling to pay his rent, adding to his stress. With his $5,000 savings, he realizes that he must find a way to generate passive income to alleviate his financial pressures before it gets worse. Peter decides to follow in the footsteps of Warren Buffett and explore dividend investing. But he has two choices: to go for a safer, low-risk technique or pursue riskier, high-reward methods, which we're going to show in this video. We'll guide Peter through 8 dividend investment strategies, starting with the safest and generic ones all the way to the riskier and most rewarding approach. Follow closely and watch this video until the end, because we'll demonstrate how Peter can make fast money to offset his motor vehicle loan quickly using the riskiest strategy in the end. Number 1. Dividend-paying stocks. You see, dividend investing is a strategy where investors purchase stocks that provide consistent cash payouts to shareholders as a reward for owning their stock. Warren Buffett often emphasizes the importance of investing in companies with a durable competitive advantage and a history of consistent earnings. The S&P 500, a stock market index tracking 500 large-cap U.S. companies, is a reliable starting point for dividend investors. This index boasts an average dividend yield of around 1.5% to 2%. One such example is Procter & Gamble, a company known for its strong brand and consistent performance. Currently offering a dividend yield of about 2.4%, Procter & Gamble fits Buffett's criteria of investing in high-quality businesses. For instance, if Peter invests $5,000 in Procter & Gamble, he stands to receive the following: $5,000 times 2.4% equals $120 annually in dividend income. Another relatable example is Johnson & Johnson, which currently offers a dividend yield of around 3.3%. Known for its diversified healthcare products and robust financials, Johnson & Johnson has a long history of increasing its dividends. If Peter invests $5,000 in Johnson & Johnson at 3.3%, it would equal $165 annually in dividend income. In reality, these investments in stable, high-quality companies ensure that Peter's portfolio remains resilient and continues to generate reliable income over the long term. Buffett often advises it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Procter & Gamble and Johnson & Johnson, with their consistent dividend histories, represent wonderful companies that can provide reliable returns over time. Peter now wants to repay his car loan, and with interest rates rising, he needs to earn extra money and repay the debt quickly. Here are the options where he can pay off his debt quicker. Number 2. Dow Jones Dividend Aristocrats. The truth is, the Dow Jones Industrial Average, or DJIA, tracking the performance of 30 large-cap U.S. companies, features a select group of dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Warren Buffett values companies that have demonstrated the ability to grow dividends consistently. Take McDonald's, for example. As a Dow Jones Dividend Aristocrat with a current dividend yield of around 2.6%, McDonald's is a reliable choice for dividend income. If Peter invests $5,000 in McDonald's at 2.6%, it will equal $130 per year in dividend income. Here's the thing: investing in companies like McDonald's, which have a proven track record, ensures that Peter's investments are safe and profitable. Peter is also looking to meet his financial obligations and steadily increase his wealth without relying entirely on salary deductions. This next method will demonstrate exactly how. Number 3. Dividend-focused ETFs. Dividend-focused ETFs offer a safe way for Peter to earn extra income by investing in a diversified portfolio of dividend-paying stocks. The Vanguard High Dividend Yield ETF, or VYM, is one such option, focusing on high dividend yield companies. As of mid-2024, VYM boasts an annual dividend yield of about 3.5%. If Peter invests $5,000 in VYM at 3.5%, he would get $175 per year in dividends. As it turns out, this diversified approach minimizes risk while ensuring steady returns, making it an attractive option for Peter's investment portfolio. Buffett advises, diversification is protection against ignorance. Peter benefits from diversification by investing in VYM, reducing the risk associated with individual stock investments while enjoying a steady income. The next strategy can help Peter earn some cash to buy a new laptop to study and analyze the market at his home office. Number 4. Sector ETFs. Sector ETFs allow Peter to focus on high dividend yielding industries such as real estate, utilities, and consumer staples. The Vanguard Real Estate ETF, or VNQ for instance, tracks the performance of the MSCI US REIT Index, comprising companies that invest in real estate. As of mid-2024, VNQ has a dividend yield of around 4.2%. If Peter invests $5,000 into this ETF at 4.2%, he would get $210 per year in dividends. This investment not only provides dividend income, but also exposure to the real estate market, enhancing Peter's portfolio diversification. Buffett often emphasizes understanding the businesses you invest in. Risk comes from not knowing what you're doing, he says. By investing in sector ETFs like VNQ, Peter can gain exposure to specific industries with higher yields, while still maintaining a level of diversification. Now, Peter might want to invest in real estate for the first time ever, which we're going to see in this next section. Number 5. Real Estate Investment Trusts, or REITs. REITs own and operate income-generating real estate properties, distributing at least 90% of their taxable income as dividends. Simon Property Group, or SPG, a popular REIT, currently offers a dividend yield of around 5.4%. If Peter invests $5,000 into Simon Property Group at 5.4%, he would get $270 per year in dividends. But wait, there's more. This strategy provides Peter with exposure to the real estate sector without the need to buy physical properties. Buffett advises to buy into a company because you want to own it, not because you want the stock to go up. Investing in REITs like SPG allows Peter to gain from the staple income of real estate without the challenges of property management, aligning with Buffett's philosophy of investing in income-generating assets. Now you might be wondering, what stocks can elevate Peter's earnings into the millions in a couple of years? To do this, Peter is considering investments in specific high-yield stocks. Let's explore them in this next section. Number 6. High-yield stocks. High-yield dividend stocks offer higher dividends but come with increased risk. AT&T is a telecommunications company as an example, which currently offers a dividend yield of around 5.9%. If Peter invests $5,000 in AT&T at 5.9%, he would get $295 annually in dividends. Believe it or not, this high-yield stock can provide Peter with a significant income stream, but he must remain mindful of the risks involved. AT&T's high dividend yield is attractive, but Peter needs to consider the company's debt and competitive pressures in the telecom industry. Now, Peter can ensure his investments remain robust by focusing on well-established companies with strong fundamentals like the one we're going to talk about next. Number 7. High-yield stocks, master limited partnerships. Here's the thing. Stocks in this category offer higher dividends, but come with even more risk. Master limited partnerships, or MLPs, in the energy sector are one such option. Enterprise Products Partners, or EPD for instance, currently has a dividend yield of around 7%. If Peter invests $5,000 in Enterprise Products Partners at 7% interest, he will get $350 annually in dividends. Here's the deal. While MLPs can be rewarding, Peter must be aware of the unique tax considerations and market risks associated with them. Buffett often warns against chasing high yields without understanding the underlying risks. He says, never invest in a business you cannot understand. Peter should thoroughly research MLPs like EPD and understand the energy sector dynamics and tax implications before putting his money in. Peter is now looking for investments that can provide him with substantial dividends to pay his car loan quickly while still maintaining a comfortable lifestyle. Here's the riskiest option to consider. Number 8. Business development companies. BDCs provide financing to small and mid-sized businesses and offer high dividend yields. Ares Capital Corporation, or ARCC for instance, has a dividend yield of about 9%. If Peter invests $5,000 in Ares Capital Corporation at 9% yield, he will get $450 per year in dividend income. As if that's not all, BDCs can be lucrative, but Peter must be aware of their higher risk profile and potential market volatility. Buffett's advice, risk comes from not knowing what you're doing, is particularly relevant here. Peter needs to thoroughly understand the BDC's portfolio, investment strategy, and market risks. Despite the higher risk, the substantial dividends from BDCs like ARCC can boost Peter's income significantly. Peter now envisions a future where he can sustain his lifestyle entirely through dividends, working only part-time. Click the video on your screen to see how he can achieve this dream.